We can get started. Thank you, everyone, first of all, for joining in. This is Getting Ready for Year End Close webinar part 2. So, those of you who have joined the part 1, which we kind of have a couple of weeks back, we will be sharing the webinar recording very soon. And this is going to be part 2, and I'll shortly touch base on the agenda as to what we're going to be covering in this webinar. Just a little quick housekeeping items. We kind of recording this webinar. If at all you guys have any questions, feel free to put them into chat. We have our team who is gonna try best to answer them. This is gonna be the 3-part webinar series, out of which we already had the part 1 completed. This is gonna be part 2, and then we'll be having the part 3 webinar. And as we kind of through with the whole webinar, we'll also be distributing some of the resources with this. We'll kind of share with the recording as well as some of the checklist and other resources with you guys. That's that. Those of you who kind of don't know me yet, I'm also gonna take a few seconds just to quickly introduce myself. I'm Hardik. I'm one of the founder at Xenett. I'm an accountant with 15 plus years of experience. And from our own experience, we created Xenett. Like in my entire career, I got to deal with so many different applications, especially involved in a lot of migrations, cleanup, review kind of work. And eventually that led us to I would say, develop Xenett. That's a real quick introduction. Now, what you will be learning, first of all, what we are trying to do is that as the year end is approaching, we're kind of getting pumped up with some of the things that we want to do to have a smooth and efficient year end close. So we're gonna literally deep dive into different processes involved or different steps involved in the year end process. In the last webinar, we actually touched base on how to first of all get started with the year end close process, wherein we did cover. Let me just gonna touch base real quick as to what we exactly covered in the last webinar. So we actually cover as to how exactly to get started with the year-end process. So we kind of do some cleanup activities to start with. Cleanup activities as in, like, you got certain transactions uncategorized, or you got some transactions which are miscoded, or you got some transactions that are duplicated. Issues like this don't really require you to wait for the year end. So the very first thing that we should be doing quite often is to take care of these issues on the go. Second thing is obviously to make sure your banks and credit cards and loans, the reconciliation needs to be done. That's what we actually talked about. And then we also deep dive into what to review in bank accounts or what to review in credit card accounts. In fact, we also discuss about what are the different issues in undeposited funds and how to find it and how to fix it, right? Just to quickly touch base on bank accounts and credit card accounts, these are some of the points that we should be keeping an eye on. With the bank accounts, we want to make sure, like, unclear checks, not kind of unclear since long. We look for transfer entries, ACH entries, or any sort of payments that have not cleared from the bank account, right? We also kind of keep an eye on transactions like journal entries as such. We don't really expect any sort of journal entries in the bank accounts, but at times, if you are literally recording journal entries in your bank account to record any deposits, we want to make sure that those transactions are not something like hanging in there since long. So you want to make sure that only transactions that you should expect ideally in bank accounts should be the checks, and that too should be the ones that you expect to get them cleared in kind of next few months. That's like a bank accounts. We also talked about undeposited funds, where the only I would say the only balance that this account should have is more of the last payments that you expect to get deposited in the future. So that's that. Clearing accounts, we also talked about it, like similar to undeposited funds, where we kind of expect that this also this particular account should also carry the balance that should get clear in the next month, like immediate next month. So the good example of this that we discussed was the Stripe. I mean, typically we have some Stripe payments in the balance sheet that should get deposited in the next month. And that is what we discussed. Like, we want to make sure the balance in this account should only consist of last 2 to 3 days, right? So we kind of did touch base on with the examples, and we literally open up the balance sheet, and we literally kind of looked at different transactions. So I just wanted to quickly touch base on that. Today, we plan to touch base on different topics, like account receivable and accounts payable. I'm gonna take care of. I mean, I'm not literally going through in a balance sheet format. The way I'm doing is that, like, accounts receivable and accounts payable, because both of them have got similar review points. So I'm gonna cover them together. So I'm just gonna get started with the accounts receivable and accounts payable for now. All right, so let's talk about account receivable and accounts payable. The whole purpose of reviewing accounts payable and account receivable is to make sure that whatever balance that is shown by customers or vendors are legitimate, are genuine, right? Meaning, like, whatever is there, it's truly receivable or it's truly payable. Number one thing that I generally do while reviewing account receivable and accounts payable is that whenever we pull the aging report, let's say if I'm just gonna pull up the accounts payable aging summary for now, right? You guys can see accounts receivable. I mean, my QuickBooks screen, right? Okay, perfect. I just wanted to make sure it's that. Number one thing that I generally do whenever we review accounts receivable, accounts payable is that we look at the report as of using this current. Right now, I mean, I'm pretty sure you guys know what this current means, is because, see, my goal is that whatever vendors in this particular case is showing this balance should be the actual payable balance, right? If I'm looking at report date, it wouldn't really give me an idea whether any of these vendors have been actually paid in the future months or not. So see, right now we are looking at December 31st, 2022. But typically, when we are working on year-end close, we could be standing in February or March or April. So whenever we are looking at this aging report, we want to make sure that it is very much possible that many of these vendors may have got paid during Jan to April, right? So if we are looking at this report on report date, we're not gonna able to find out that, right? So in order for us to see, like, even the exact payables as of today, I would use this current method, and then I would just run this report. So whatever this report tells me, like, this is all the vendors which were due as of 12/31st, 2022, and even as of today, these vendors are showing this much balance to me, right? So this is how I kind of generate this aging summary report, and that's how I look at it. Now, there are different things that we have to keep an eye on while reviewing the aging report, right? Number one is the immediate one, which is the negatives, right? We should ideally not expect any negative vendor balance in here. There could be times where there could be some genuine scenarios where you could expect negative balance, but, like, the only time that you would see, like, it's literally an overpayment, and you know that, hey, for this vendor, let's say this was genuine overpayment, which you also know that's going to be adjusted towards future invoices, that should just be fine. But otherwise, every negative vendor balance should be questioned, like, why it's negative. Is it because, are we missing any bills? Or is it because something like the bill is recorded in a different vendor, payment is recorded in a different vendor, right? The situations could be anything, but the number one thing we kind of trying to do is, like, first of all, we're trying to understand that what could go wrong here when we are looking at this aging summary, right? So number one is, I'll kind of keep an eye on what is negative, and then we'll further investigate, like, why it's negative, right? Is it going to be adjusted with the future invoices, and accordingly we can kind of say that, hey, this looks okay or not. So let's say if this vendor was a genuine like overpayment and they had overpayment, then we would just fine, we'd just be fine and we'll just leave it as it is. But then if we figure that, hey, there was a missing bill, the bill was not entered, or bill was voided, or bill was deleted, in that case, we'll have to make sure that we record appropriate bill and then adjust this payment towards that particular bill. So that's number one thing that I generally check. A second thing is we look for the vendors with like negligible balance. And when I say negligible balance, is like more of a subjective in nature. But for me, I would just look for any vendors like someone has 0.12 or someone has 0.30 or someone has 0.75, because it's not so common. So I have created an example here for this vendor. This particular vendor is showing like 0.25 balance is like outstanding. Now, what I have seen is that most times this balance could kind of show up is when, let's say in this case, 1300.25 was the total outstanding, but then we ended up paying, like we rounded off the payment amount like to 1300, right? So while making the payments, we just didn't consider those decimals. We just paid for the full amount, I mean for the rounded amount that was 1300, and then it is kind of showing me the balance of 25. So it's a small thing, but again, no point of hanging in there for like forever. I would suggest that if we know that this balance has arisen like because of this rounded, because the payment was done with a rounded amount, would suggest to, I would say, adjust this balance and then make sure that we kind of provide the adjustment, and like it should be basically written off in the books, right? So that's another thing that I look around if any vendor shows this kind of negligible balance. Now, number three, I look for is zero balance. Now, even though this balance is zero, does not really mean it's right. See, we are looking at aging, which means we're looking at the vendors which we like, whom we owe something, right? Now, in this particular case, if it is zero, that indicates that in this vendor, there is some bill or expense or payments which are not applied towards each other, right? While it does not make your aging balance inaccurate, like it's not going to have any impact like on this 89K, but it's a good practice to not have any zero balance vendors here. So if you see any of the vendors with a zero balance, that means the bills or the payments are not applied against each other, and we should be applying that, right? So that's another point that we also check here. Okay, so that's that. We also look for the unapplied payments, especially when I say unapplied payments is when I don't have a good example here, but imagine you got a bills open and then you got some payments that are not applied against those bills, right? So like you got, let's say you got some bills open here and then you also see some negative amounts here, right? So that's also another thing that ideally we should not have any unapplied payments. If there are payments, those payments should be applied towards the open or unpaid bills, right? So that's another thing that we also pay attention to. Now, the most important thing that we also pay attention to is anything that is like overdue, right? So, like in this particular case, like I mean, obviously this is an example, but there are so many vendors which haven't been paid for a while. Uh, I would suggest that a proper investigation should be done, like why it's overpaid, like why it's unpaid since long, right? The most, I would say, the common answer could be, I mean, like they are literally have not been paid, right? But even before concluding that, we want to do some sort of analysis from our end also, like because there are chances. Imagine there are chances that the vendor may have been paid, but instead of recording it as a payment towards the open bills or unpaid bills, we may have recorded an expense directly, correct? So I specifically check even before concluding that, hey, these are all genuine bills that are unpaid yet, I would do a quick analysis to make sure that it's not like the case where the payments got recorded as an expense. For that, what I also do is that I kind of check the, I would say, transactions trend analysis. So let me just show you how I actually review this kind of stuff. So just a second. So what I've done is that I have a view transactions type inconsistency. In that, what I'm kind of checking here is that, see, look at this kind of situation. So if a vendor has a bill, but then other than bill, if the vendor has a check or expense, then it means, like, this is a good example. In this case, we have been recording bills. If we are recording the bills, then we should expect bill payments, not the expense, right? So what this may mean is that most likely the expenses were the bill payments, but got recorded to the expenses directly. So the bills are still unpaid, and then the expenses got booked again in form of the expense transactions, right? So this is where I would confirm that, like, in simple words, if I summarize it for you, if I'm, let's say, recording a bill for any vendor, I should not be really recording expense directly. I should have a bill and then the bill payments. Now, what this gonna tells me is that in this case, there might be possible that this bill is, even though it says unpaid in my aging report, but these expenses that have been recorded could be the payments towards this bill, right? So this is something that I personally check whenever we are looking at the aging report, right? So like, this is something I would suggest, that we should not literally assume that like, if it is I would say, if it is not paid since long, it could be possibly that it's really unpaid. At least we do homework from our end before even approaching to the client. One of the things that we like, once we have checked this, like, and confirm that there is no duplication, what I also do from my end is informing client that, hey, you got this bills to be unpaid yet. And one of the exercise we should also be doing as a part of year-end cleanup is that, see, if there are any vendors which our client tells that, hey, this is something I'm not gonna pay, or this is something is in dispute, or something that that client thinks it's not gonna be paid even in the future, it's better off writing them off, because if we don't do it, those vendors gonna stay here forever, right? So this is again the last thing that we do. Like, once we get the feedback from client, then we're gonna be adjusting some of these vendor balances here. All right. So these are some of the things that we check when we look at the aging summary. Now, if I talk about the account receivable, it's more or less the same thing only. Like, for example, we look for the customers with the negligible balances. We look for the customers with the negative balances. We look for customers where there are unapplied payments. So then we make sure that the invoices and the payments are applied accordingly. Then we also look for the customers with the, like, old invoices. And again, with the old invoices, we also check the same thing. We want to make sure that there are no deposits or payments directly recorded as revenue, as opposed to applying towards the invoices, right? Because then it might lead to the duplications. So these are some of the common points that we check. All right, I just remembered one more point that I specifically check with the accounts payable is the cash vendors. Now, I created some examples here, like there's a vendor called Lyft, or there's a vendor called Uber, right? Now, we should not really have any sort of vendors like cash vendors, as in Amazon or Lyft or Uber or McDonald's, or things like that, right? In one of the client, I have seen that these guys were recording the like, based on the receipt, they were recording as a bills indexed, and it was syncing as a bill, and while recording the credit card transactions from the bank feed, they were also recording expenses. So those bills were also remaining unpaid in here, right? So a quick attention should be paid, especially with the accounts payable, to just quickly look around and see that there are no cash vendors as such in this list. All right. So these are the points that we would generally check when it comes to accounts payable and accounts receivable. All right. Let me just take you to the close. So, and the way I have set it up is that, see, and there's so many points which we don't want to forget about it. So the way we follow is that we kind of literally created a checklist. So whoever is reviewing it will have to make sure that they kind of did this, right? And depending upon the type of the client that you guys are following, you can actually customize it. So for example, in some clients, we also use some external system like bill.com. Now, if I use bill.com, which means there's additional checkpoint that I have to do is that the balance in my books and the accounts payable balance in bill.com should match also, right? Because whenever there's a third party system that you're integrating with, then you want to make sure that your aged balance should also match. Okay. Similarly, in case of account receivable, if you guys are using any billing system from where you kind of syncing the data, there you can add additional point to reconcile your balances with each other. All right. So these are the points that we would require to pay attention to whenever we are reviewing account receivable and accounts payable. All right. Let me just gonna quickly see if there are any questions. Apparently, I don't have it. And while I'm explaining this, guys, if you guys think that hey, there's something that you guys also do it from your end, which I'm not covering, I would also encourage everyone to put some comments in the chat. So that way, if there's something I'm missing out, we can also cover while we are discussing this. All right. That's that. All right, now let's talk about, let's say, prepaid expenses. What exactly do I check or do we check whenever we work on the prepaid expenses? All right. Now, I'm not gonna explain anything about what is prepaid expenses and things like that. I mean, it's like pretty basic. But number one thing that I check with the prepaid expenses is that I like be able to identify what should even fall under prepaid expenses. So what I do, like depending upon the type of client, we basically create some rules. Like anytime, first of all, what kind of expenses you would expect to be the prepaid expenses? Like the most common ones are like software subscriptions that you might be paying in advance, or you might be paying like insurance in advance, right? Or you might be sometimes paying rent in advance. So those are some of the expenses that you kind of end up having prepaid expenses. So number one thing that I have it here is that I specifically look those accounts in my profit and loss just to make sure that there are no as such payments that are eligible for the prepaid expenses. So what I did here, I created a rule that anytime if there are any expenses more than certain amounts, the amounts could be $2,000 or $5,000 or $3,000, whatever you decide for your client. You want to check those transactions and see if they are actually prepaid expenses or not. So what I did here is that I created a custom review point. Like it says, review possible prepaid expenses. I don't need to go anywhere to look those 3 or 4 or 5 different accounts. I can immediately pull up from here. Like if there are any such transactions, I can see there are some big amounts here, like 35, 7,000, $13,000, right? So now I can kind of go into these transactions and then find out, because these amounts are quite material, right? Doesn't sound like these were the expenses for that particular month. So now if I have any document, I could open up and then see if this expense was done for the more than like few months, like more like it's a long period, right? So then we would be able to say that whether this is a prepaid expenses or not. So this is a point that I have created here. if I see 0 here, which means there are no such transactions that are eligible for the prepaid expenses. So that's number one point that I kind of check here. Now, assuming that there are no such prepaid expenses, we also have a kind of prepaid schedule that we maintain every month, and that schedule will help us know what expense to be recognized and what should be the outstanding balance. So what we have done here also is that we kind of manage that or update that schedule every month, and we reconcile the amount as per books with the schedule. So as a part of this close process, I have this account here called prepaid expenses. It says balance as per books, which is 5,600. And then I also have a schedule attached here. So let's say, for example, if I kind of open up from here, I can then immediately reconcile it whether the balance makes sense or not. So here in the separate Excel file, we kind of keep track of all the prepaid expenses like, hey, this was the expenses, this is the period, this was the amount, and this is the recognition as per like across the different months. And my goal would be that whatever balance that I am showing outstanding here should actually match with this GL balance, and that should be the checkpoints that we follow with the prepaid expenses, right? So these are the two things that we generally keep an eye. Number one, look for any sort of new prepaid expenses, eligible prepaid expenses. If there is anything, then yes, we need to make some provision or make some adjustments for that. And the second thing is that based on the schedule that we follow every month, we need to make sure that we kind of record the prepaid expense recognition entry, and then we also make sure that the balance, the as per schedule and the balance as per book should match, right? And again, this practice has been helping us. Like my staff would come here and would just put the reconcile balance, because this will force them to confirm that whatever balance that they are writing here, it's all verified, it's all confirmed, and it's matching with this schedule. So this practice has been really helping us. All right. Yeah. So that's pretty much it about the prepaid expenses that we follow. All right. Now, I'm also going to take care of employee advances, which I know it's not so common. I mean, you're not going to be finding it for every single client, but it's a good point to be covered as well as a part of year-end close process. Now, typically with the employee advances, the most common practice that I have seen that is happening is that we kind of give advance to a person or employee either through payroll or we write a check directly, right? And then from the every pay period, we deduct some amount. Like let's say every pay period, we're gonna be deducting 500 or 700, right? And that's how we're gonna be deducting. So what I have also done here is that I kind of created, I would say, custom review points in such a way that, let's say, when I click here, I literally see the summary for every single employee here, right? And while we talk about this, let me also share how actually the entries should be done. Now, I have seen lot, actually not lot, but many clients where we just dump all the transactions of employee advances in one single account. Now, which is still be fine, but then it's very difficult to find out what transactions like belongs to which employee, right? So it's like when you are looking at employee advance account, you probably can kind of are looking at 30-40 transactions, and you have no clue as to which employees owes what, right? Because if you just dump all the transactions like that. Now, I have seen some clients where they end up creating different sub accounts under the employee advances. So imagine like you got a one account like employee advances as a parent account, and then underneath you got employee advances account for every single employees. That would still work fine, but I would suggest it's not advisable because employees keep changing, and it's not advisable to create accounts for every single employee, because then like it's going to be so many of accounts, and then you end up into deactivating those accounts or making them inactive and things like that. So What we follow is that for every single transaction, whenever we give the advance, or whenever we deduct the advance, meaning we receive it back, we make sure to assign the employee name to every single transactions. And then we just simply group it by the people, like by the employee. So this is kind of pretty clear to me right now, like, hey, this is David Miller. I can see 1200 was given, and then the, like, I can see like we've been deducting $200 from his payroll. I can see the consistency as well, like 11:15, 11:30, 12:15, 12:30. And this is how it's like, this is like, I can clearly see what was paid off and what is the balance yet, right? So that's pretty clear to me. Now, uh, we also need to pay attention to the other kind of situations which we have also come across, is that, like, there might be some deduction, but there is no I would say advance recorded separately. And we have seen that in this case, let's take an example of this employee called Patrick. We can see the advance, like there are deduction entries, but there is no advance given entry. Now, most likely we have seen that if you come across this kind of situation, the most common problem that we have seen is that the advance amount got clubbed or got recorded as a wages, as a part of the salary. So imagine whenever you were recording a payroll, instead of separately I would say pulling out that advance amount, we just ended up booking that advance amount as a expense all like together. So that means that, like, this is wrong. I mean, we need to have this advance amount recorded here, and that's how we also need to make sure that we kind of have the accurate ending balance. And this is what I was saying, that it's going to help us if we literally have an employee name assigned to every single transaction. Problems like this can easily be identified, as opposed to dumping all the transactions and then juggling around here and there. So that's a situation that we have to keep an eye on. Like, we need to make sure that there's advances and then there's deductions. And similarly, we also need to make sure that if there are advances, we should also expect some repayments. So in this particular case, I see that there was an advance given somewhere in August. There is no repayments. Like, now, again, it is also very much possible that this deduction got actually clubbed with some of the other benefits or some of the other deductions that are there in the payroll, right? So we also need to make sure we need to pull up the payroll report, find out what happened here, even before addressing it to the client, right? So these are the simple things with the employee advances. It's a best practice to have the breakup, or I would say breakdown, managed by each employee. So every month, I'm just gonna come here, like, I need to make sure that this 1600, I need to make sure that like have the breakdown by each employee. And then when I kind of click on it, I kind of clearly see that, hey, this employee owes this much, right? So this is the easiest way to review the employee advances account. All right, that's that. All right, no questions yet. Now let's talk about the fixed assets. So fixed assets is where we have certain points. Number one is that we kind of have a capitalization limit defined for every single client. Now, in this case, I have set the capitalization limit as $2,000. So what this means is that it says capitalize fixed asset purchases that are more than $2,000, which means that I have identified certain accounts where if there are any transactions more than $2,000, I want to see them, and then I would decide if I want to capitalize them or not. So those accounts, let me just show you. So those accounts could be like depending upon the type of business, but I would say like repairs and maintenance, or if you have some office equipment accounts or tools and machineries accounts, right? Some of those accounts which could be possibly capitalized, we have mapped it here. So now all I need to do, I can see there are two transactions here. By looking at these two transactions, I would be able to decide whether I want to capitalize them or not, right? Now, if I think that it was more like a big purchases like the laptops and or more like a big repairs and maintenance kind of expenses, I might then decide to capitalize it, and then I might just move them to the fixed assets, right? Or furniture or whatever the account it could be, right? So this is a one point that we check in the fixed asset. Okay. Now the second point is that in the fixed asset itself, the same $2,000 limit I would also apply it. So if my, like, imagine if there are any transactions in the fixed assets that are recorded and it's less than $2,000, I also don't want to capitalize them because I mean it's pretty small amount to be capitalized. So in that case, I have also created a point here that says expense out any purchases that are less than $2,000. I can quickly pull up all those transactions right here. Like in this case, for example, I can see, I mean, these are not even worth capitalizing it, right? All I could do, I can select them all and I would say, hey, I wanted them to move them to office supplies, apply, and it's done, right? So this is another check that we also do is if we see any amounts less than certain amounts, like we can then decide to expense the amount rather than being capitalized. That's another point. All right. Now, one more thing which we are very much particular about having documentation for the newly assets that are purchased, right? If I see any new assets being purchased, I want to make sure that we need to have proper documentation in place for that. And so what I have done is that I have created a view that it's going to pull up all those new assets which don't have attachment, correct? So then in that case, it will then be easy for me to directly create a question, ask my client that, hey client, can you please send me document, and kind of we're gonna be getting that document soon. Now let me tell you why it's important to have documentation for the new asset purchase. Now, in fact, I have experienced this with some of the clients is that uh, when we are purchasing any asset, not always it's like a one payment. I mean, at times it could be happening like you might be paying in three parts, or you might be paying some amount as a down payment, and then you might be paying some installments across the period as well, right? So if we are just simply relying on recording assets based on bank or credit card transactions, I mean, we may not be able to catch it, right? So that is why we need to have like that is why we need to make sure that we need to have documentation for every new assets that we purchase. In fact, I don't have a situation here, but I'll give you an example of what happened in one of the client where the client actually bought the car on like loan. So what happened was like the 15 or $3,000-4,000 were paid as down payment, and then there were monthly installments. Now what happened was, because there was one payment of $3,000 or $4,000, we booked the asset for those $3,000-4,000, and then all those monthly payments someone booked as like a lease payments because they did not have any clue that those monthly payments were not the lease payments but were actually the payments towards the car that was purchased, right? And that is how the documentation helps. Like whenever we see an asset, we want to make sure that we understand the whole transaction, because at times the clients might be trading off as well. Like in this particular situation that I was talking about, even the old car was traded off, right? So that's why we put I would say emphasis on making sure that we need to have documents for every transaction or every purchase that we have it, right? So that's on fixed assets. Any questions, guys? I know I kind of keep going. I'm not seeing any questions in the chat, so I thought we'll just ask if there is anything that I need to answer or cover. Looks like we are going fine. All right, that's fine. Now let's talk about the security deposit. It's also pretty straightforward, but because we generally see the security deposit on the balance sheet, I thought we'll just cover it. I mean, security deposit in most cases we see in case of rent, that we kind of paid, let's say, 2 months of rent in advance, or with electricity or utility vendors where we kind of paid some security. So those amounts we gonna be seeing here. Now, this is the balance that we don't generally expect to get change every now and then, right? In fact, in this case, I would say that if there's a change in the balance, that means like we need to pay attention to like why the balance is changed here, right? So in this case, we want to make sure that if the balance is changed, it's all because we paid some new deposits, or it's very less likely that the past deposits may have got adjusted towards the payments, right? So all we have to make sure is that generally the balance should remain same. If there is any change, we want to pull up like, so again, in this particular case, I'm going to click on the amount, just quickly see if there are any new transactions. If not, we should be just fine, right? So that's what we kind of check with the security deposit. All right. Just gonna quickly go through and want to make sure nothing is missed out here. All right. So now, I mean, if we further talk about the liability, I mean, we already talk about the accounts payable. We also talked about the credit card reviews. Now let's talk about the accruals as well. Right. Now, the expense accruals, I have seen different kinds of accruals as such, right? Number one, I have seen is merchant fees. Now, especially in case of merchant fees, we have seen some merchants where what they do, okay, all right. So this is what I have seen. Like some merchants, what they do whenever they are depositing money into our bank account, they deduct part of their fees and then deposit the net amount, right? In that case, merchant fees is just fine. I mean, there is nothing to be done with that. But then we have seen that some merchants, what they do is that for the entire month, let's say, for example, we are in October, what they do for the entire October, whatever deposits that they have done to our bank account, they're going to calculate the merchant fees, and then they're going to deduct that merchant fees on third or fourth or fifth of the next month. So what I mean by that is that the October's merchant fees actually get deducted on 5th of the November or 4th of the November. Now, in this case, I have seen that, I mean, we typically make the accruals because the expense belongs to October, but then because it's like withdrawn from bank on 5th of the next month, it gets recorded in the next month. So this is one accrual that we were typically making to like for the, especially for the merchant fees. So we debit like the merchant fees expense in I would say October, create the liability for accruals, and then whenever the payment is done, we kind of adjust it towards that. So this is a kind of one kind of accrual that we were doing it. Another accrual, obviously, for the payroll that I have seen, where I mean, obviously, if we are following, let's say, weekly or bi-weekly payroll, where if the days fall, and we were pretty particular about calculating the payroll, where if the month falls in between the payroll cycle, we literally figure out that, hey, how many days belong to this current period, right? And that's how we calculate the payroll accrual based on the number of days. And then we make the accrual, and then we also reverse it out on the next pay period, right? So this is like another kind of accruals that we also make here. And as you can see, we kind of also have some details about all of those different, and it all depends on the nature of clients, but I'm just saying the different kinds of accruals that I have personally dealt with. All right. The third kind of accrual is obviously where we are missing out an expense, especially with the bills, right? Is like, let's say for October month, we have not yet received the bills for utility bills for whatever reasons, right? So in case of missing expense, where we know there's an expense, but we don't have a document, we again take some educated guess. We kind of look at the history, find out what could be the probable or estimated accrual amounts. We make the accruals and then we reverse it out also. Now, another fourth type of accrual that I have seen is again not so common, but especially with there's some auto charge vendors. Like I do have some vendors that they're gonna charge me on last day of the month, right? Now, typically, I mean we do it on the like cash basis, like as and when it occurs. So because as such, what happens is that let's say 30th of this month, October, I'm gonna get this expense, it gets booked in October, so I'm okay with that. But sometimes uh, because of the holiday or for whatever, the expense gets charged in the next month. So for example, November's expense get charged on my credit card on 1st of December. Now, if we are literally recording this kind of expenses based on credit card or bank, November would not have any sort of expenses, right? And that's where we kind of book the accrual. And the best way we actually identify this kind of accruals, let me just show you. So we have this review expenses review point. This is pretty helpful because what this does to me is that I kind of have an overview of all my expenses across the months. So like imagine if there are any expenses that I see every month and in one month there is no expense, this would trigger me that, hey, I need to make accrual for that particular vendor, right? So this would generally help me. So we make sure that we kind of have a quick review of this report here. One second, I'm just gonna say Jan to December here. So even before making accruals, we would make sure that we kind of look at this, just make sure that all those recurring expenses have amounts every month, and then we'll just make the accruals accordingly for the missing ones. All right, I'm just gonna go to close. So what I've done here, I mean, typically, like we have this standard checklist, uh, which actually it's pretty comprehensive and it actually covers a lot more details. So what we then do is that, like, I kind of rated it at uh, the company level, meaning the practice level. Now, depending upon because some clients may not have account receivable, some clients may not have security deposit, some client may not have employee advances. So depending on the nature of client, we will then decide, excuse me, which one to keep or which one not to keep, right? So like we have a standard one that we applied, and then once it's applied to client, then we make certain changes which are specific to the client. So that's a best practice. And as you know that it's a one-time thing, but once it's set up one time, this has been helping us a lot, because then I mean it's I would say it's very rare that we find any errors after one has gone through the entire process, because one is literally going through every single checklist, signing it off, making some comments, looking at these transactions. So that way it's very rare that we find errors while we are performing the close, right? And especially the thing is that, because let's say imagine if I were the reviewer, I can also see visibly, like it's pretty prominent to me as well, because now I can see the counts as well. So like, for example, if I'm going through this close process and I can see this is zero, I can see this is zero, this is zero, which then tells me that things have been checked and things have been taken care, right? So that also gives me confidence about our close process, that all of those tasks have been performed thoroughly. And one more thing that has been helping us quite a lot, I know, see, at the time of preparation, like at the time of working on close, it might take few seconds here and there with this practice, where we ask our people to attach documentation, but I can tell you, not only it saves, first of all, not only it saves us time from our internal review, it also makes sure that things have been thoroughly checked and one has not missed out anything. And this has tremendously helping us, because all of those information that we are compiling here, we are eventually sharing with someone who is filing taxes for us. So in fact, we are also making their life easier, because we are in fact avoiding any possible questions from them as well. Because whatever accounts that they are looking at, let's say my tax preparer is looking at balance sheet, right? Imagine like this: for every single balance sheet account here that we see, one second, for every single balance sheet accounts that he's saying, we literally have documentation for every one of it. Like if we had any question for any of this account, immediately pull up the statements here, can see that this account is matching and it's all good, right? So every single account has documentation. If there are any observations, we also put it here, right? So this has been tremendously helping, not only from our internal process perspective or having I would say internal control perspective, but also overall making our year-end smooth process very smooth. Because previously what used to happen was that, like, we would spend a lot of time internally, first of all, to verify the numbers are accurate, and then all we were literally doing was just simply sending the balance sheet and profit and loss. And then we would get so many questions that, hey, how did you come up with this balance or that balance? Get me this document. So this practice has really helped us avoiding a lot of these unnecessary questions. All right. So that's that. I know we kind of just 5 minutes away from today's session. We still have a few more items to cover. I'm not gonna be covering them today, but just to kind of quickly touch base. So we will be covering payroll in our next webinar. Payroll accounts, especially payroll liabilities, clearing accounts, payroll tax liabilities, loan accounts, sales tax, and then we also do have certain other activities, cleanup activities, even the equity accounts, how to review them as well, right? So we're going to be touching base some of those accounts, and then we do have some more bonus tips as well as a part of the year-end cleanup that we'll be covering in the third. I would suggest, guys, also if you guys have any questions, feel free to participate, or if you want me to cover any specific situations, like, because I know depending upon the type of business, you might come across different accounts on your balance sheet, right? I know one more common account are intercompany accounts as well. So if there are any such accounts that you want us to cover, I would suggest you guys know the email. Just feel free to send us an email, hardik@xenett.com, and we'll kind of make sure to even bring up those points in our next discussion as well. All right, so that's pretty much it for today's session. We will be certainly be sharing this today's webinar recording once we are through with all the three parts, and we'll also be sharing the resources with all of you guys. I hope you guys found this today's session helpful and you learned something out of it. We will reach out to you very soon about the when we are going to be scheduling the third session, third webinar for year-end close. That said, guys, I hope you enjoy the today's session. Thank you very much for joining in, and we'll we'll kind of see you soon in our third webinar. Thank you, and I appreciate it.